All right, let's get over to Matt Graham. Matt Graham's here with an update on the markets. Matt, at least the markets have moved back to somewhat lower, but where are we going? What is going on? Give us some. Good to have you here.
Yeah, good to be here. And that's how they get you, David, is they have you convinced that moving lower is worth anything when we're moving lower to 4.22 whatever in the 10-year treasury yield. But to take a page out of David Kittle's book, rates are where they are, and they're not probably going to come down much anytime soon. But then again, my purview here is to talk about market movement. So I'll do that really quickly. Rates are still high, and they started last week at the highest levels in a couple decades for mortgages and since 2007 in 10-year treasury yields. A lot of that was an extension of the previous week and a half's momentum and not really based on any new developments in the market. And that changed on Wednesday when we did have new developments in the market. Everybody's been saying, the Fed and market watchers, economists, and forecasters have been saying that economic data is important. And then we saw this little run up to higher rates that didn't really connect very well to economic data. But now coming back in the other direction, we did see a solid connection on Wednesday with the PMI data from around the world, really. And that's a purchasing managers index, and it's like a more timely GDP, if you will, broken into the services and manufacturing sector. Markets tend to focus on the services sector more than manufacturing right now. And that's what was weaker in Europe in the overnight session. And that kicked off a snowball rally in the bond market. And then when the US version of the services PMI came out at 9:45, it reinvigorated that rally and made last Wednesday one of a handful of days that 10-year yields rallied more than 10 basis points and mortgage rates dropped more than 1/8%. And fueled maybe some hope that we had seen a ceiling for the time being. That is the sort of conclusion on which the jury will be out until we get additional data. But at the time, the reason that was given or suspected for the market not rallying even more on Thursday was that we had Fed Chair Powell coming up at Jackson Hole on Friday morning. And there was like a lot of market expectation and buzz about things he might say that he's A, already addressed, or B, has said he's not going to change his mind on anytime soon. But nonetheless, people were wanting him to say something about R star, or the neutral Fed funds rate that perfectly balances growth and inflation in a sustainable way. And other people have surmised that he would talk about a change in the inflation target. He put both of those things to bed fairly conclusively, saying 2% is the target. And then actually ECB Pres Christine Lagarde said the same thing in her segment later in the day, and saying that would just undermine central bank credibility even more if we were to go around changing our inflation target. So forget about it. And on the topic of R star, Powell basically said, hey, look, there's so many variables right now. He didn't say these words, but this was my interpretation. We've already had some challenges with dialing in monetary policy in the wake of COVID. It would not make any sense to guess about what R star, if it needs to change. We don't even really know exactly what it is, and we're constantly in a state of figuring it out. Both of those things were put to bed. The market had a little bit of a hawkish read on it, and that translated to higher short-term rates, 2-year treasury yields and Fed funds futures. And it didn't hurt longer-term rates as much, which just sidestepped into the afternoon after a little bit of initial volatility. But all in all, Powell didn't say anything super new, no major surprises. It's data dependent. They may or may not hike again. There's a certain amount of restrictive monetary policy that's already in place due to the current level of rates, and we don't know exactly how much restriction that's going to transfer to the economy and to inflation over time, because these things take time to play out. All of that left the focus squarely on economic data. And with all of that in mind, this week has a ton of economic data, super relevant stuff. JOLTS, job openings and labor turnover survey, tomorrow, then ADP employment and GDP on Wednesday, and core PCE, or just PCE inflation, and jobless claims on Thursday, and of course the big jobs report on Friday. all of those reports in and of themselves have been responsible for a decent amount of market movement if they've come in far from forecast. And if they do so again this week, no reason to expect that would change. As far as rates, I think there is a little bit of seller exhaustion, and that may have been seen on Tuesday when rates stopped going higher the same pace and without any real motivation in terms of data or underlying events. And then Wednesday, I think that paved the way for the PMI data to really have a bigger effect than it otherwise might have. So if sellers are indeed exhausted, if they're looking for an excuse to buy, and if economic data were to come in weaker than expected this week, then we could see whether or not there is a will to counterattack against the recent rate spike. Either way, it's going to take, I don't know, weeks, maybe months of cohesive messaging in the data for a sustained shift back toward lower rates. Conversely, if the data somehow miraculously pointed to runaway growth, then yes, rates could go higher, as a lot of people are worried about. But it's all up to the data, and the data hasn't come out yet, so we'll wait to see what it says.
Very interesting. Mr. Kittle or Mark Helm, any questions for Matt?
I'll start it off if I can. Matt, I'm reading a lot in, I'll call them rags for no better terminology, about rates and projections for next year. And Mr. Kittle alluded to it, and he probably will talk about it here in a minute. But a lot of people are predicting that the rates will be high until about July of next year, and then miraculously they'll turn and drop quite substantially pre-election. Do you think, what's your take on a political party in office having the ability to say and do things to get the rates to drop that much at a whim? I just like your opinion on this. I'm reading, I read like a couple things a week for 3 weeks about that now.
Yeah, I haven't read anything about a political party having an influence on rates. And I don't believe any political party can make rates go lower. I think the easiest thing for an administration to do or for Congress to do is to make rates go higher, either by issuing more debt or cutting taxes. And so we've seen both of those things with the tax cuts, pushing rates higher, and then most recently with a ton of spending, creating excess treasury issuance and pushing rates higher, not to mention the fiscal policies that arguably caused a good amount of the recent inflation post-COVID that pushed rates higher. I think almost all of the political banter that I've heard and seen surrounding the rate cycle being tied to the election cycle is coming from people that are always going to force any market movement into a political context, whether it deserves to be that or not. And I think that's probably one of the most unfortunate things with respect to the discourse between politics and economics in the US. And I really wish people would do less of it and focus more on the objective details.
Yeah. I guess sometime when people doing that, you also got to remember who their audience is. People want to hear those kind of things.
Absolutely. Yeah. And that's the unfortunate thing, not about politics, but about the internet and social media and just where we've come as a society in terms of the level of stimulation we need intellectually and emotionally when we're digesting our media. I prefer it much more boring personally, but I understand most people don't.
Yeah. Thank you, Matt.
Thanks, Matt. Mr. Kettle, any thoughts?
Sure. I'll step in and say I'm one of the persons that Matt is talking about, and he likes to look at data. So go back and look at the data over the elections when rates have been affected over since Jimmy Carter. And you'll find that when people make the statements like myself, that rates are going to fall before an election or they'll change before an election, they absolutely, by and large, most of the time do. And they do because, which he did say, because of the policies in place of that particular administration, up or down. We have policies in place now by this administration since he has been in office that are inflationary, period. We've borrowed money we shouldn't have borrowed, paid for things we have. And do they all do it? Absolutely. But we're talking about the environment we're in right now. So I'll say again, I think rates are going to fall And the administration, because of what they say, their narrative, how they act, including Congress, has absolutely an effect on what happens to interest rates. And it happens, and you just go back and look at it. And listen, next September, October, if I'm wrong, I'll be the first one to say so on this show. But I go back a lot longer than most people on this call, except for Mr. Lykken. And I mean that affectionately, David. I've seen it all the way back from 18.5%, and I've lived it. And so I'm going to stick by it that politics do have an effect on interest rates because of what is put out there.
They 110% have an effect. I just think that it would be very hard for politicians to make rates go quickly lower to serve political purposes. It's much easier for them to push rates higher.
Let's be clear on something. I've never said that Biden's going to make it done. I just said that it's an election year. I'm just covering what I've said on the show. And this is good. This is good debate right now. On this show, I said it's an election year. Rates will go lower. Didn't say who, what, when, or why, but watch it happen. And if I'm wrong, then I'll be the first one to say, hey, I blew it.
Yeah.
But historically, that's what happens.
Historically, it has happened. And at least the last 3 election years, we had Brexit going into the middle of 2016, which was pushed rates lower around the world. And then we had the Greek and European debt crisis in 2012, pushing rates lower around the world. And in 2008, I don't need to tell you what we had, pushing rates lower around the world. So sometimes there are third variables in play. But
true, but everything you just mentioned was done by political decisions. Brexit, politicians making decisions on currency back and forth, or whatever you want to say. There's still politicians making decisions. We say we live in free markets. We don't. We live in manipulated markets. There's not a free market out there right now except the choice for individuals to buy or sell.
Absolutely. You can't separate the impact of politics on rates.
Right.
There's no question. Yeah. I would not ever disagree with that.
Yeah. Then we agree.
Yeah. The point is, though, whatever's going to happen, you need MBS quote line.
Well,
whoops. There you go.
You could use it. You could use something else. Yeah.
We're not going to use that. I haven't used that forever. I don't know why I go back to that. It's just rolled out of my mouth for so many years. No matter what's going on with interest rates, you need to check out mbslive.net for the latest activity, because when you're talking to your consumers, your borrowers, those people that you're hoping to get a mortgage with or for, you need to know what's going on. And what Matt has offered through mbslive.net, it happens, and it's excellent. I love your system, Matt. Thank you so much for being here each and every week. You can sign up listeners and get an extended trial period by using LOL and the sign-up code. Again, I tell everybody, just sign up. It's so dang affordable. Why not? So appreciate it, Matt. Thanks for your report. Thanks for the discourse on this. I love the dialogue, listening to the different perspectives, especially as we get closer to an election year. It's very interesting stuff. Thank you, Matt. Appreciate it.
You bet.